to keep their assets denominated in any unit of account. Hayek also argued that a competitive market for currencies would actually encourage governments to take their offerings a bit more seriously. They'd have some incentive. If the pound was competing against 6 other currencies, the British government would think twice about implementing policies that would depreciate the value of the pound, because you could just switch to another currency. So now, just picture for a second the implications of unrestricted optionality. You can go out there, you can transact in any currency of your own choosing. It might not make a big deal for us here today, but for a lot of people in oppressive regimes, they could easily buy in and out of a stable unit of value. They'd no longer be subject to the tyranny of failed economic policies. So let's fast forward. 33 years later, Bitcoin is invented. Now, Bitcoin is a lot of things. A lot of people feel like Bitcoin is a scam. A lot of people say Bitcoin is a waste of energy. But let's go with the formal definition of what Bitcoin is. Bitcoin is a decentralized peer-to-peer currency. Satoshi Nakamoto, whoever or whatever he is, sat down there and he came up with this new vision for what money should be. So Bitcoin is a fundamental shift in how we understand money. It reminds us that in its purest sense, money is no more than a linguistic abstraction. Money is a way we communicate value to one another in order to coordinate action. Bitcoin also reminds us that the ability to transact freely is important. It's a bit like the ability to think or speak freely. It's one of the cornerstones of individual liberty. So one could say on January 2nd, 2009, Hayek's thought experiment was realized. Money, for the first time, is separate from its previous notion of government as the sole issuer. But the question is, do we all realize the significance of this moment? Morning again, guys. My name's Jeansy Malanza. You can tell by the name I'm French. I was born in Kinshasa. That's in the Democratic Republic of Congo. Lived there for a couple of months. There was some conflict brewing, so my family emigrated to South Africa. I lived in South Africa, in Johannesburg, for about 15 years. Did my primary school and some of my secondary school study there. Moved up to the UK. I've been here for 15 years. And yeah, did my studies. Got a master's degree in computer science and management from Loughborough Uni. Got a job out of uni, working in a bank. Started out in collateral management, moved to equity finance. So right now I work as a software developer. On a day-to-day basis, I work with Java, because that's like the enterprise, favorite for a lot of companies. But in my spare time, I also touch a bit of Python and Angular. I'm not a React guy. I'm an Angular guy. So I know that will divide some opinion in this room. So yeah, I'm a full-stack developer. On the right-hand side, there's a picture of my family. As you can see, I was quite happy. I don't know what faces my sisters are pulling there. My dad, tall, massive guy. I'm so upset I didn't inherit his height. But he bought me my first computer. It was in the early 90s, and I started my programming journey by working in a language called BASIC. I'm not sure if a lot of you heard of it. We didn't have video games at that time. We had to write our own video games to entertain ourselves. So it was really old school. But since then, I sort of progressed, did some HTML, did some PHP, then I learned about Angular JS, and then they stabbed me in the back and they came out with Angular, and I was like, I have to learn everything again. But yeah, it's been a crazy journey. My mom, lovely woman, just her devotion and how she's made sacrifices for her family. It serves as a template for anything that I go after in life. I try and demonstrate the same passion as her. And my 3 sisters, my fondest memory of them is we always used to fight over the computer. So I wanted to do my own stuff on the computer. They wanted to jump on and do their own stuff. So yeah, they're lovely as well. They just keep me grounded in life, and stuff. So yeah, just a bit about me and my life. I hope we can form a bond or something as we, because we're stuck with each other for the next 45 minutes. So yeah, let's start with a quick question. How do you guys think, if we all went out for lunch together, how do you think we'd split the bill in 5 years' time? Okay, we're gonna do a quick poll. So put your hands up if you think bank card. So we're gonna split the bill, with bank cards as we are at the moment. Okay, cool. Put your hands up if you think cash. We're gonna split the bill out with cash All right, cool. No worries. Put your hands up if you think digital currency like Bitcoin and stuff like that. Okay. Oh, that's lovely. I hope you guys aren't just putting your hands up because the talk is on digital currencies. But you know, I appreciate that. I appreciate that. So yeah. So let's start with a working definition of what digital currencies are, because I appreciate that there might be some people in the crowd who might be thinking, what on earth is he talking about? So I think a very simple way to define digital currencies is that they are a digital representation of value. You know, so digital currencies, sort of abstract away money from its hard form or the form that we currently understand to just bits and bytes. Digital currencies can be centralized. When I say centralized, they have administrator or a third party that controls the system. A good example of a digital currency that is centralized, if any of you guys have played Fortnite, you've got V-Bucks in the game. So that's the type of in-game currency that is administered by the developers and so on of Fortnite. Then you have decentralized digital currencies. They're a relatively new thing. They've only been around for like a decade, and they have no central authority. But really, the term digital currencies is an umbrella term in my mind to classify different examples of money. So the Bank of International Settlements, captured this really well, this fluid concept really well in this money flower diagram. And I think, digital currencies just sort of like, cryptocurrencies sort of like just fill this narrow void there. So stuff like Bitcoin, Ethereum, they just sit there. But there's really like a massive overlap there of what a digital currency can represent. So the focus of this talk could have been exclusively on cryptocurrencies. I could have just spoken about how much I love Ethereum, Bitcoin, Zcash, and all that stuff. But you know what? The more I've started thinking about it, the more I start to think to myself, well, really, innovation can come from anywhere in this space. Innovation can come from open source. Projects like Bitcoin, Ethereum, Zcash, they could be the ones that drive adoption. Innovation can come from Facebook. It could come from the enterprise space, because Facebook's working on their own digital currency as well. So they've got a reach of 4 billion users. So that could do a great deal to sort of drive adoption in the space. And innovation can come from government as well. So imagine the US government or the European Central Bank, created their own asset-backed digital versions of the dollar or euro. And we could do massively for adoption all over the world. So, I'm not exclusively wedded to the idea that, innovation in the space needs to come from cryptocurrencies. It can come from anywhere. And that's the point I was trying to make through this slide. So, what's the purpose of this talk? The purpose of this talk is to provide a socio-economic case for competing currencies in Africa. I would have loved to do a deep dive technical talk on blockchain and stuff like that, but I thought, let's talk about why we need this stuff. Let's talk about, why it's important rather than go into the cool technical stuff. So, when we approach this topic, as I was doing my research, I found that, our approach to reasoning about these things can be either framed as incremental or anarchic. So these are two perspectives that one can sort of like view these things at. So when you're an incrementalist and you listen to this talk, or you listen to this talk and you walk away with an incrementalist perspective, you're thinking, wow, that talk really fired me up. I want to build stuff that is going to improve the inefficiencies in the current legal and financial jurisdictions. I'm going to work within the regulations that the government is setting. I want to really want to innovate the space the right way. But on the opposite side, if you're an anarchist, you're going to walk away from this stuff and say, I'm just going to destroy the legal and financial distributions that exist out there. So if you're on Twitter and you follow a lot of the guys in the Bitcoin space, they're quite like far along the anarchist space. They just want to destroy everything. They're like, everything needs to be decentralized. So both of them both sides have very strong convictions, in the power of decentralization and open finance. I've heard it from people in both sides in the space, but they both want to deal with the authorities in their own way. So for the purpose of fairness during this talk, I'm going to remain impartial. I'm not going to pick a side. But after the talk, it'll be interesting to hear from you guys, what you guys feel your position is. So let's talk about my road to Bitcoin quickly. So when I first encountered Bitcoin, and the experience was, I was quite pessimistic about it. I was like, I did some research on it, I did some reading, read the white paper, and I thought to myself, this is just magical internet money. It doesn't make sense. Why would anyone want to use Bitcoin? I mean, it's a stupid idea. I looked at the blockchain, I studied it in depth, and I thought to myself, this is a stupid data structure. It won't scale. It doesn't make sense. It's just. I mean, it's a nice way to think about, consensus, achieving consensus in a group of people that don't know each other. But it doesn't make sense. So I bought some Bitcoin. I went against my inner judgment and bought some Bitcoin. And the price of Bitcoin rose. It rose. And then I was like, whoa, I might have made the right decision here. And I started to view it as an investment. Because, the purchase sort of like slowly was sort of coincided with the bull run in 2017. The price rose. And I was able to double my initial investment. I was like, oh. I looked at myself in the mirror. I gave myself a black man nod. I was like, yeah, you did it. You did it. So then I thought to myself, let me try a thing. Let me try a thing, So I took some money out. I said, let me invest a bit more into this Bitcoin space, But the price of Bitcoin went down. It didn't end well. So we had a WhatsApp group, and we were talking. We're like, man, maybe it's because of the Chinese New Year. The people in China aren't buying Bitcoin at the moment. So after the Chinese New Year, the price will go up. Chinese New Year came and went. Price was still going down. So I was like, oh, wait a second. Wall Street bonuses. That must be it. The big bankers in Wall Street, they haven't received their money yet. Maybe, when they get their bonuses, the price will go up. Bonus season came and went. Price still went down. And maybe it's the Bitcoin futures, They're announcing this Bitcoin futures on these exchanges. Maybe that's it. They're announced, the price kept going down. So a lot of the mandem left. Bitcoin is now a taboo subject in some circles. You don't talk about it. People lost money. A lot of people were calling me saying, Jeansy, man, I lost 6K. I was like, I mean, I don't know how to console someone like that. I don't know what to say. I was really impressed by our faith during this period. It was unwavering. At times it felt like a cult. You believe in something so much that you hope it's going to turn out well, but it didn't. But ironically, it was at this point that, I started to develop more of an interest in what the utility for digital currencies in general could be. I realized this is actually exponential innovation. I started to think more about, what these, digital currencies can use for and the implications it could have for society as a whole. And I realized, wait a second, this is actually 0 to 1 thinking. And when you're looking at something that is like 0 to 1 thinking, in the early days, it's very difficult to see the potential for disruption. Because if you think about Bitcoin and how it operates, the use case is just too complicated for most people. But when you start to deal with new realities, I found that sometimes you have to think laterally. Because when you start thinking laterally, it kind of overcomes your tendency to get stuck into a set pattern. So my interest started to increase slowly. I started doing more research. I started thinking about it a bit more and more and more and more and more. So guys, don't be deceived. You go out there today, there's a whole bunch of fintech startups. They're doing a thing. They're like, oh, we're disrupting finance in this way. It's our app. You could just open your bank account with an app. It's a new way of transacting finance. But a lot of these services, if you look at them from a technical perspective, they're just disrupting the application layer. They're just touching the application layer. Everything underneath it is still the same. It's, and if you think, okay, I don't really get what you're saying. Okay, go try and open a bank today. Go try and open your own bank. At some point, you're going to have to touch Visa and MasterCard's infrastructure. You don't have a choice because they're the gatekeepers. But with digital currencies, they fundamentally change the application and the protocol layer. Financial institutions can be bypassed completely. You don't need to depend on Visa or MasterCard's infrastructure. And as a result, you can build systems where transactions can be completed in minutes rather than weeks. We have a house down in South Africa, and we hired someone out there to do some work. You had to fix the gate. So I was like, okay, cool. The work's done. How do you want to be paid? He's like, can you put the money in my bank account? And I had to think. So how am I going to get the money from my UK bank account to his South African bank account? There's no clear connection. So I used TransferWise. The payment took 7 days to settle. I was like, really? In 2019, 7 days? It's ridiculous. So you start to realize when you do these type of transactions on a frequent basis, when you're sending money back home to family, when you work in the finance sector, you realize that we have payment networks today that are inefficient. They're inefficient at large transactions. They're inefficient at small transactions. They kind of do either one of them right or wrong. They're not perfect. But digital currencies kind of place us on a path of convergence. You can compress micropayments and giga transactions into just several bytes. Just send it across people as you wish. So a single network can now, support payments in pennies and billions. You don't believe me? Just check Bitcoin out. You can send 1 million Bitcoin and one Bitcoin, and it will cost you roughly exactly the same. Depending on what the network fee is at that time. But we'll talk about that later on. I mean, we'll talk about outside the talk. I'm not going to go into that. So yeah, the flexibility of this payment network is crazy because you start thinking about it and you're like, wow, we can actually use this as the base of a new modern market-based monetary system. So let's explore why we need this and what this means for us. So before we go into talking about these things, it helps to sort of establish a working definition of what money is. What is money? Sound money, good money, what is it? Well, you can think of sound money as having 3 properties. Firstly, it's a medium of exchange. In order for money to be sound, you have to be able, it has to be widely accepted. You should be able to go into any store and that medium of exchange, that money has to be acceptable. You can't just go in there with some foreign currency and just, take this. Don't be silly. And secondly, money has to be a unit of account. It has to be easy to measure in economic transactions. So you go into a shop, you don't have to do any sort of mental jujitsu to figure out, okay, the price of that. You just know, oh, that's £1, that's £1.50. I've got £5 in my pocket. I can afford those 2 things. It has to be a reasonable unit of account. Thirdly, money has to be a reliable store of value. This is where a lot of digital currencies fail, but we'll talk about that later. Money has to be able to hold its value. So you don't want to get paid £10 today. You walk into a shop tomorrow and your £10 is now worth half the amount. That's not good money. There is a fourth unofficial property of money that I consider. That people don't actually appreciate, but I've started to notice it more and more. A lot of people believe that money has to be issued by a sovereign authority. Because money has to be issued by a sovereign authority, it means that we have to outsource our trust to the sovereign authority. And in the UK, we have the Bank of England. And we're lucky in the UK. We have a very strong, well-regulated financial sector. The Bank of England, Mark Carney, they're good guys. They're looking out for us wherever they are. And despite inflation, depreciating the purchasing power of a pound, a lot of people use Freddos to measure the strength of the pound. It's going up. It's been going up over the last few years. But we're confident. We're confident that we're not going to go to the bank one day and see our beloved pounds lose half of their value. So as a result, we can make economic decisions that are more orientated towards the future. Now let's diverge quickly. I'm tired of talking about digital currencies. Let's talk about marshmallows. So, kids out there, I know you love marshmallows, so I made this slide especially for you. So in the 1960s, there was a Stanford professor. He decided to carry out some psychological studies pertaining to marshmallows. He called it the Marshmallow Experiment. It's a very creative name. And, the experiment began by, there was a group of children, and he'd bring the children into a private room, and he'd sit them down, and then he'd put a plate of marshmallow right in front of them. And the child would look at the marshmallow. They'd be pleased. They're like, oh, lovely. Kids love marshmallows. But then the researcher would say, listen, kid, I'm going to walk out this room. If I come back and you haven't eaten this marshmallow, I'll give you another one. So the kid would smile and be like, oh, it's either I eat one now and don't get the other one, or I wait for 2. So it was an exercise in delayed gratification. So these studies went on for a while, and they were used as the basis of a lot of research. People were saying that, oh, you know what? The kids that were able to delay, and wait for that second marshmallow actually had better life outcomes because it shows about the way that they're willing to sort of orientate their decision making towards the future. But let's just stop there. I mean, I didn't buy that, because obviously, we should dispel any notion that a child is going to be impaired in life if they only eat one marshmallow. Come on, man. Just because you decided to wait for the second marshmallow doesn't mean that your life outcomes will be improved. And this is what happened over the studies, over the years. The studies started to attract a lot of criticism. People were like, wait a second, let's check the profile of these kids out. Oh, they come from middle and upper class backgrounds. So they were kind of, they were well off. And we started to see that the studies were a bit biased. They didn't really reflect the general population as a whole. However, from this bias, we can learn a couple of things. We can learn that, your disposition, maybe your social class, maybe plays a role in your ability to delay gratification. If you're in that situation, and you're well off at home, maybe you were used to the comfort and to the security that comes with being in that environment. You could wait for that second marshmallow. And does it make sense? On the other hand, for a child who's been brought up in the turbulence of poverty, to make a decision to wait, I don't really think so. I think they'll just take that marshmallow and go. Because they don't know the second one's coming. They're not used to the security of the future. So from this marshmallow experiment, we can establish a working definition of a concept called time preference. Now, time preference simply means the extent to which someone favors their present over future well-being. So a person with a high time preference is more concerned about catering to present needs than those of the immediate future. A person with a low time preference places more priority on the needs of the immediate future. So as rational human agents, we tend to prefer, our present well-being because, the future's uncertain. And, there's a need for day-to-day survival in general. But it depends on your context as well, because, your context can influence whether you have a low or high time preference. But one thing for sure is that, every time you make a decision, you're fighting a battle between your present and your future self. So I made this point about how privileged we are to have a stable monetary system. We take it for granted. Because when you think about it, the expected future for value of the British pound in our context, has an impact on our life outcomes in general. The pound is quite good at holding its value. Reasonably good. And when money is better at holding its value, people are less inclined to spend it immediately. You get some money, you get paid, you start making plans with it. You might want to save it for something in the future. You might want to say, I'm going to save for a deposit on a house. I want to get a nice car. I want to save for a holiday. You can make economic decisions. Oh, I want to save for my studies. That are sort of orientated towards the future. But imagine when money loses its value quickly. You get that money, and it's a ticking time bomb. You're like, the value is depreciating second by second. You're not going to put the money in your bank account. You're going to spend it immediately before it becomes worthless. And as a result, your life outcomes dramatically change. The prices are increasing faster than you can spend your money. It's a terrible situation to be in. And this phenomenon is known as hyperinflation. Now, hyperinflation is when the price of goods or services, rises more than 50% per month. So we saw it in Germany with the Weimar Republic in the early 19th century. Seen it in Venezuela, Zimbabwe. Terrible situations. And it quickly erodes the real value of the local currency as all the prices of goods and services just quickly increasing. So we're going to look at a few case studies where, hyperinflation has played a big role in societal structures. So let's talk about Zimbabwe. Now, currency instability in Zimbabwe started in the early 1990s. President Robert Mugabe was sitting there one day, and he was just thinking to himself, you know what? These white people are bothering me in this country. They're bothering me. So he started a land reform program. He said, I'm going to take back all these private farms from all the white dons in this country. People at that time probably thought, yeah, this is a good idea. Yeah, black power. Yeah, we're taking our land back. Didn't play out as well. Didn't play out as well as expected. It led to a steep decline in food production. Zimbabwe was known as the breadbasket of Africa. It doesn't have that title anymore. And it started to have implications for the banking and the manufacturing sector. Shops in Zimbabwe would change their prices several times a day just to keep up with the hyperinflation. You want a basket of groceries, you'd have to go in with a trolley of cash. It's crazy. So in 2009, the Zimbabwean government said, the Reserve Bank of Zimbabwe decided, you know what, we're just going to abandon this. We're just going to leave this currency. The Democratic Republic of Congo, my home. And in Congo, we have this thing we call the paradox of plenty. Rich in natural resources, but rich in natural resources, but most of the population suffer from extreme poverty. They live on about 20 cents a day. You go walk the streets of Kinshasa, and all you see are currency traders. Hey, mon frère, come over here. I can give you some good dollar. Selling dollar at a premium. Because people want to get out of the alien Congolese franc. It's useless. And as you start looking a bit deeper, you can see that people are barely surviving. Whenever inflation hits, a small increase in their costs can push them and their dependents into hunger. And as you can see in both contexts, the result is a gradual dollarization of the economy. The Congolese, if you go Congo, they don't like Congolese franc down there. If you come with dollar, they'll listen to you. And it's really sad because people have completely lost trust in a sovereign currency. So what we start to learn from these case studies is that top-down economic mismanagement is a global pandemic. There's countries outside of our continent that are experiencing this issue, like Venezuela, Iraq, and Turkey. People in these places really find it difficult to align their economic decisions towards the future. It's hard. Like I said, so when someone acquires US dollars or any good currency, do they spend it straight away? No, they don't spend it straight away. They keep it. They keep it because they know that it's going to serve as a hedge against any sort of impending fluctuations. Payments are made in the less valuable currency first. And this phenomenon is known as Greshams Law. And it states that, bad money, if not limited in quantity, will always drive out good money in an economy. So what have we learned? So we've learned that there's a strong link between countries' macroeconomic policies and an individual's life outcome. We might not see that connection straight away, but when we start ripping the layers, we can start to see that, wow, something's going on here. But the cool thing about digital currencies is that, they can offer a degree of financial optionality. They can serve as a useful hedge against a failing formal economy. So in 2016, a gentleman called Gary Heilman, he introduced the Bitcoin Market Potential Index. And as you can see, on the right-hand side, there's quite a few sub-Saharan countries out there. And what he was trying to understand was, in which countries with digital currencies have the greatest relative potential utility? Got some interesting picks on the list there. It's quite interesting. Why is Iceland there? I probably need to look it up. So yeah, there's quite a lot of opportunities that that exist for us. If we want to go out there and build value in this emerging space. So we spoke about hyperinflation. Now the contrast of hyperinflation in this context is something that has been called hyper-Bitcoinization. Now with hyperinflation, people abandon the domestic currency once they realize it becomes useless. With hyper-Bitcoinization, people abandon currency for digital currencies. It's not happened yet, but it might happen one day. It might not happen in our lifetime, but it's going to happen one day. And it's going to happen because of this thing of this idea of soft promises. When I talk about soft promises, let me relate the soft promises idea to a real world analogy. We all have a friend. We have a friend who promised us something, but he never delivers on time. He lets us down. And then, it's like, I'll be there at 10 minutes, 1 hour later. It's not there. He always makes promises he never keeps. But fortunately, we have the opportunity to leave such friends. You can just be like, I'm not seeing you today. Bye. Hang up the phone. But it's sad that a number of people in these developing countries, have those friends, but they're actually government. In a country like Zimbabwe, for example, in October 2018, the government did a crazy thing. So Zimbabweans at the time, they were like, okay, you know what, we'll put our US dollars in our bank accounts. They thought, hey, bank accounts are a safe place to keep our money. But not on October 1st, 2018. They woke up, they went to the banks. So Zimbabwe has these crazy capital controls. You can only withdraw a set amount of money per day in US dollars. So they went there and they're like, oh. The bank tellers were like, yeah, we've replaced your US dollars with something else. And I was like, excuse me? Yeah. It's this new currency that the government's issued. We've just taken out your US dollars and we've replaced it with something else. Did I ask you to do that? But it's the reality of a financial system in these countries. It's built on soft promises. It can never guarantee you anything. Every promise it delivers can be reversed and broken. But with digital currency, we have programmable money. Now, when money is programmable, you start from a system of hard promises. Money, in this context, becomes software. And if you know something about software and you're a developer, software will always execute exactly as it is written. Now, for a lot of people, this scares them. They're like, wait a sec, if I send my Bitcoin, for example, to someone else's, to the wrong address, does that mean I can get it back? No, you can't get it back. It's gone. Oh, okay. I don't know about this thing, Payments are irreversible in certain contexts when you talk about digital currencies. So people, like I said, people have a hard time grasping this. They think, there's something wrong with this system. We need to fix it. But because of the money, they don't realize that because the money is programmable, you can flex it down. You can start with these hard promises, and I just add parameters that, okay, cool, we'll give you the right to sort of get your money back after 30 days if you want. You can program that in. So as a result, you can build systems within these new currencies that protect consumers. And it's not been seen before. And then you realize that, we're starting to build systems of autonomy, not systems of authority. Not systems where someone is out there dictating things, but systems where we're free to transact as we please. The results are still unalterable, but you can make it more people-friendly. But in order to make these ideas more palpable, we need to change our understanding of money. So we need to think of money as something that moves value between us in containers, in stores of value. So right now, we have the national stores of value, which have been controlled by banks and, controlled by governments and distributed by banks. So the thing about containers is that, it imposes specific restrictions on the way that money can operate. Currently, when we think about money, we don't think of money as something that is liquid and flowing. We think of something that is bulky. It takes a bit of effort to move around. Think about the nature of salary. You get paid every month, right? And the reason you get paid every month is because it's just the medium of banks and accounting platforms batch up transactions to make these things a lot more cheaper for them. So like I said, we always think about money as this container. We've just stuck on this idea of thinking about money as this container. We never think of it in its purest form as a means of transmitting value. But this disposition is challenged whenever the medium changes. So think about it. 10 years ago, or 10, 15 years ago, the way a lot of us interacted with music was through MP3s. Any of you guys remember Winamp or Windows Media Player? Old school, Napster, BearShare, Aries, LimeWire, all that stuff. That's how we used to get our music. You had your friends who had the latest MP3, like, can you send me that tune? And you just pull out your phones and Bluetooth songs to each other. It was awesome. But now music streaming has changed the way we consume things. Today I prefer to use services like Spotify, if I'm honest with you. I place a lot more value on playlists, curated playlists, and music discovery. I don't really want to hold 30,000 songs on my phone. If I'm shuffling 30,000 songs on my phone, I could just jump from Justin Bieber to drill. And if I'm listening to a playlist, I can say, the person's put some thought into the way these songs have been placed. I'm feeling it. It's lovely. I can go gym, got my gym workout on Spotify. I'm like, yeah, it's fantastic. I stream my music from a provider. So in a decade, my attitude towards music has changed. All of our attitudes towards music have changed. In fact, we now value the experience of music rather than the ownership and permanence of it. And it's an interesting sort of step forward. So what happens when we start to think of a new container for money? How do you think we'll see it? We've got a blank canvas. So in this section, the last section, we're going to talk about what we could build. So we've got digital currencies at layer 0. We're going to talk about the stuff we can build on top of that. Um, I'm of the opinion that the most successful African fintech companies of the future will be built by people who understand Africa. I feel like right now we have a lot of startups who are not really solving African problems. They're just copying business models in that they see in Europe, and they just sort of repackage it and build something similar back home. And when you're building a startup that is solving an African problem, it might not seem like the most exciting thing. It might be small, it's solving a really narrow problem. It might not make you look smart, but you have to start from somewhere. I mean, my approach to these things is always learn, build, scale. So let's look at some ideas. So where can digital currencies in Africa have the most adoption? Well, you know, first thing, offline payment protocols. I mean, this is something that no one really wants to do or no one really cares about because, you know, like I said, they don't really understand how Africa, the composition of Africa. There's lots of places in Africa where, you have spotty network coverage. So it makes, the whole process of making mobile payments hard. So people just resort to cash in this instance. So if you're trying to build a system that is going to mirror cash and its utility, you sort of need to cater for these scenarios as well. So we need systems that, make it easy for people to be able to transact between each other without a signal. Protocols that can authenticate transactions almost without the need for network, without the need for SMS messaging or text messaging. Also, we have to take into account that the total cost of mobile ownership is about 10% of an African's uh, uh, medium average per income. Most people won't be using the latest smartphones. A lot might be using feature phones. So as I was doing my research, I actually found a project that does this stuff. It was being headed by the University of Cambridge. So they built this project called Digitally. And what Digitally basically did was it let people transfer money from one phone to another by swapping 8-digit codes. It's pretty cool. When offline, the system would store the balance as a counter in your SIM. And once one of the participants in that transaction went online, their transaction history would be uploaded to a server, so they would keep the system in sync somehow. But the challenge with all these systems is decentralization. If you want to go down this decentralization route, how do you decentralize an intermittent network that's always on and off? It's very difficult. So yeah, I mean, with a project like this, I think it's kind of difficult to get started on something like this. You need some experience in Java card programming. You need you need to be using these old phones and stuff like that. You need to have some cryptographic knowledge because obviously there's issues with transaction replay. Someone could just stay offline indefinitely and find a way to sort of trick the system so that the transaction, their balance is never a true reflection of what they actually have. So it's quite difficult to sort of build something like this. A second thing I was looking at more of these ideas, and I came across this cool company called GoTenna. So GoTenna basically built this like mesh network that you can use out in the wilderness. Like you could be anywhere. You could use, and the way it works is that it connects to nearby GoTennas, through radio frequency. So you could quite easily build a payment network on top of this. All of us here in the room could be part of a mesh network, and we could just be one person can send a transaction to another person, and then the transaction could then bounce around in the room until it finds someone with internet access, and then it just uploads to a server. So it's an interesting idea, and it's useful. This kind of stuff is useful in unstable regions because if you've been watching the news recently, and the Congo and the Zimbabwe with the recent elections, the government at one point just decided to switch the internet off. They just shut it off. Switched it off. They're like, yeah, no one has access to WhatsApp, anything. With these sort of networks, you can make them censorship resistant. That's amazing. But there can be legal implications. Now we're going down the anarchy route. There can be legal implications of this kind of stuff, and it can be quite expensive to set up. So I was doing some more brainstorming about what platforms could be built. And messaging services are quite an obvious pick, and they would help in the process of humanizing digital currencies to people. Because they expose conversational interfaces. It can come in different languages. It can come in the regional language. You could just have one in Swahili, have one in French, and so on. And it could be available 24/7. A chatbot is always online. And in Africa, one thing you realize when you're down there is that airtime is money. Airtime credit is the way people transact. So in a way, they're already ahead of us because we don't use that sort of metric here. We have bundles and stuff like that. But there, you have companies like M-Pesa and so on where people just top up their credit and they can use it to buy food, pay their bills, and so on. So maybe, you could build a WhatsApp bot that operates as an exchange, and you could maybe swap airtime minutes for digital currency. And then you can extend the idea a bit. You could be like, okay, cool, maybe we can give people the facility to loan out their digital currency. Okay, we're getting interesting. Okay, you can loan out your digital currency to a local business. So you're now building microfinance solutions. And then you're like, okay, you can make the chatbot a bit more complex. Maybe you can set repayment conditions. You want the money back in 3 months, and you can set default conditions. You could build that in. And all of these things can be done easily. You could just sort of direct it towards the person's wallet through an API or something like that. But the possibilities are endless. One concept in the digital currency space that I find really interesting is this idea of Ricardian contracts or smart contracts. And they just emphasize the point that programmable money is flexible. The cool thing about programmable money, if you look at platforms like Ethereum, is that you could embed contracts and payments. You could set the terms and conditions between two parties. And all this stuff can be drafted as a legal contract, and then they could be converted into code quite easily. And it can be useful in situations where you need to sort of provide some contractual clarity between two parties, and it can introduce clauses like financial clauses that make these breaches expensive or prohibitive. So you might be thinking, well, Jeansy, these things can be done and agreed between people. You don't need systems that do this kind of stuff. But if you think about code, you can trust code. If code's being written in a particular way, you know that the code is not going to execute in a completely opposite route that you didn't expect. A person can just run away with your cash or just act in a very bizarre, unexpected way. But with code, if it's been framed at the outset of the agreement, you could be sure of the guarantees it will provide. So yeah, a lot of people talk about Jeansy, they come to me, Jeansy, you're talking about some cool stuff, but the price of Bitcoin dropped from 20,000 to 4,000 over the course of a year. And I was like, yeah, I know that. A lot of us felt that pain. We felt that pain, we felt that pain too. We're still waiting for it to go up, But recently, over the last year, there's been this new innovation that's come out called stable coins. Now, stable coins allow us to sort of reach sort of price stability while retaining the programmable features of a digital currency. So if any of you have used Coinbase or Binance in the past, you know that it's quite difficult to convert back and forth between fiat, which is real world money, and digital currency. But what stablecoins allow us to do is, offset that. So you've got fiat-backed stablecoins, you've got which hold their value in currencies such as the US dollar or euro. But these are, they're a mixed bag because they rely on you having to trust in a centralized entity such as a bank, because the bank has to hold that money. So, what with fiat-backed stablecoins, all you're doing is taking real money and you're just sort of building a layer on top of it, or a new container, so that it can operate in coexistence with other private digital currencies. And then you've got crypto-backed stablecoins, which are pretty interesting because they use other bits of they use Ethereum and Bitcoin as collateral. But because Ethereum and Bitcoin are unstable, you have to over-collateralize the deposits you put in. So if I wanted to sort of get some dollars, I'd have to put a bit more Ethereum in, maybe 1.5 times the amount, just to make sure that I can guarantee that price stability. And then lastly, you have this really sort of edge case of algorithmic stable coins. And this is an attempt by people to sort of control the monetary supply programmatically. So you'd model a contract as a central bank, and you'll say, okay, cool, just issue $1 coins. Just make sure you keep that equilibrium. When you need to destroy some coins, when the price goes out of balance, destroy coins. When it comes back into balance, create coins. Just keep that balance. But all of this is just I know it's quite hazy at the moment in my mind. A lot of these companies have had legal issues in the US because what they're doing constitutes as a security, and so they're kind of breaching, securities law in the US. So I think bases had to be shut down. So it's quite an experimental space here. It relies a lot on public perception. So the longer you believe that one of these companies is actually trading at $1, it will maintain that value. But the minute you stop, then who knows what will happen? You'll have a black swan event. So to conclude, we should all be proud to sort of be living in an era where we're witnessing a financial revolution, And we have a once-in-a-lifetime opportunity to shape it. Whenever I go to these like blockchain, Bitcoin meetups, there are hardly any sort of like people who are representative of us here. And it kind of, scares me sometimes to think that, the future of finance is being built by the same group of people that, introduce finance to our continent. So, the cool thing about digital currencies is that for the first time we can cheaply conduct large-scale macroeconomic experiments. People, we can provide people with financial optionality that doesn't exist right now. And when you don't have financial optionality in a country, what you see is that class structures start to get perpetuated more and more. The people at the top get the good money, the people at the bottom get the bad money. And as a result, opportunities, like economic decision making that is geared towards the future that can guarantee you prosperity and so on is limited to a privileged few. So like, digital currencies as we see are a nice solution for countries in which trust in institutions is eroded, and we see a lot of that all over the world. It can protect people from a dysfunctional economic system. And for the first time, people can opt out of the financial system they've been born into. Like, if I was born in Venezuela and I don't agree with what Maduro is doing, I could just be like, listen, I'm going to move all my savings into Bitcoin or Ethereum and keep it there because that's more comfortable for me. I have that freedom. But the situation's far from perfect. I don't want to paint a rosy picture for anyone here because if you start doing some digging into some of the stuff you've seen here, you think, oh, he made it sound a much better, but the situation's really, really tough. Imagine, we're in a phase where it's 1992 and the internet's just come out. And like, in this discussion, I'm trying to pitch Netflix to you. I'm trying to pitch Facebook to you. It doesn't make sense. You'll be thinking to yourself, this guy's mad. The underlying infrastructure is incomplete. There's a lot of work that needs to be done to build it. There's a lack of regulatory oversight, and as a result of that, there's a number of scams being perpetuated. And, last year, about 110,000 Ghanaian investors lost about 25.7 million because of crypto scams. So a lot of work needs to be done to educate people. So the question is, ultimately, which one of us today is going to step up, and build and create financial solutions that will change our continent and might even change the world? Let's go out there and make a difference. Thank you very much for your time.
Oh, wow.
Sorry.
Is that what we do? Okay, no, keep going.
No, I'm done. I mean, like, if you guys want to read into this kind of stuff, this is the material I recommend. The Internet of Money is really good from an idealistic perspective. Programming Bitcoin is for a technical perspective. The Bitcoin Standard is a good book from an economic perspective, and Mastering Ethereum is kind of like good from if you're interested in smart contracts and stuff like that. Some of these books are freely available online. So yeah, just go out there and get learning, I guess. Thank you.